Consumer Price Index data for November 2023 will be released on Tuesday, December 12 at 8:30 a.m. ET. Markets expect inflation will cool, with headline figures moving lower as energy prices ease. This expectation, in part, underpins the market's belief that the Federal Reserve will probably cut rates by the spring. Headline CPI inflation is expected to be basically flat month-on-month and 3% on annual basis according to Nowcasts from the Cleveland Fed. That's in part due to falling energy prices. Nowcasts use currently observable market prices, such as for energy commodities, to estimate upcoming inflation figures. However, core CPI stripping out food and energy prices is predicted to be less encouraging, growing 0.3% month-on-month and 4% annually. That's materially above the Fed's 2% annual inflation target. Event forecasting site Kalshi presents a similar view, currently estimating that headline CPI inflation is most likely to fall in a 0%–0.1% range month-on-month for November 2023. Within the numbers, the Fed will be, once again, watching services inflation. As the labor market remains generally robust, the concern for the Fed is that services prices may continue to rise materially. That's because wages are a large component of delivering most services. Then there's an expectation that a wave of deflation in goods is returning. That's something we're seeing in car prices as of October's CPI numbers, and commodity pricing, in addition to energy prices, are generally moving lower, too, which may support that trend. Lastly, shelter costs are a major component of the CPI, and the Fed expects price growth to moderate or ultimately even decline here. That's as mortgage costs have increased sharply in recent years, limiting housing affordability. For October, shelter costs rose 0.3% month-on-month, signaling deceleration in 2023. Yet home prices are still increasing at a sufficiently high rate to contribute meaningfully to inflation. The Fed won't have much time to digest the CPI report, with its December interest rate decision coming the following day. For now, the market is more optimistic than the Fed about the inflation fight being won. The Fed wants to see more evidence that inflation is returning to its 2% annual goal. Specifically, the Fed worries that inflation may get stuck at a level above 2% and that further progress on disinflation could be slow. Also, unlike the financial markets, which are inherently predictive, the Fed can generally wait for the economic data to come in before making its decision. The Fed's concern is that a relatively robust jobs market and strong economic growth may continue to create inflationary pressure. November's CPI numbers are unlikely to be decisive in shaping that debate, but do represent a relevant data point. Still, further cooling of inflation would be encouraging.